The big question on every investor's mind is, despite today's pullback, we have been in a bull run. And will the bull run come to an end? Goldman Sachs says pretty high probability of a market correction in the coming months. My next guest says it could be in the coming weeks. For more on this, we're joined by Bob Iaccino, co-founder and chief market strategist at Path Trading Partners. Good to see you, Bob.
Good to be here, Greg.
All right, here's a question I've been asking since the beginning of the year, even on days where we had triple-digit gains in New York. I get worried when times are too good that they can't last forever. You say, yeah, they're not going to last forever.
You know, I want to go on record also as saying, Greg, I've said it to you before and I've said it to Michael on his show as well, that I think the first correction, the first dip is not only going to be bought, but should be bought, but I think it's coming. We've reached now somewhere right in the range of 400 days without a 5% correction. I think a 5% correction will be sort of a double dip kind of a move. It'll go down 5%. People will be like, we got it, let's buy it. This is that 5%. And then we'll dip down again. And that's what I think is going to happen when you take the sort of three-headed monster of a weaker dollar, higher rates, and the potential for lower demand in iPhones. I'm kidding, but the intention, just the idea that there might be a little bit less growth in the U.S. with a sub 3% GDP right in the teeth of a tax cut. I think you have to buy that dip, but I think it's coming, and I agree with Goldman. I just think it's happening a little bit faster and a little bit sooner.
Now, that's the key there in the bull run we're in. We've seen corrections and bull runs before. People treat it as a buying opportunity, and then the bull continues to run. Is that what you're thinking is going to happen here? But maybe a double dip correction, but we're not actually talking about a fundamental change in the movement of money in this market.
Well, look, we got about 24% of the S&P 500 that's reported as of Friday. 76% beating on EPS, 81% beating on bottom line, about a 12% blended earnings growth rate at this point. That's only 24%. You mentioned the big shops we've got reporting this week, all the FANGs minus Netflix, got Microsoft in there. This is a big week to see whether that can continue or not. My base case for 2018 is mid-single digits on the S&P by the end of the year. That would probably portend a couple of corrections that were bought and then just sort of a sideways market. I think we're borrowing growth from 2 or 3 years down the road with this tax cut. And if that growth doesn't explode in late 2018, the idea that it's going to materialize at all, I think, is a bit of a stretch. We've got money already going out to the employees of these companies in the forms of bonuses and internal raises of minimum wages. If we don't get CapEx, if we only get share buybacks, which could be part of that dip buying, by the way, if we only get share buybacks, we don't get a significant leap in CapEx. And there is evidence that we're starting to see a little bit of CapEx, but I'd be watching stocks like Caterpillar to see if this goes into infrastructure and base materials and things like that. That needs to happen for the tax cut to be part of GDP expansion and part of higher equity prices that aren't just multiple expansion.
Now, Bob, south of the border, I'm not sure how carefully people are watching the NAFTA talks in Canada. We watched it very carefully. Of course, the U.S., our largest trading partner, and it makes us nervous when they're not happy about the deal. We've just gone through another round of talks. Montreal seems like there's a bit of optimism. Are we worried on your side of the border at all about NAFTA being scrapped and some sort of effect for your industry?
No, I think what we have is an executive branch that proclaims America first. I think if you were to pin them down and say, so what are you second, they'd say that they're this hemisphere second. So I think this is the treaty that is the least at risk in terms of just completely being blown away and no NAFTA agreement of any sort existing. Donald Trump, his rhetoric tends to be more important to him than what actually comes out in the final deal. What he says to his base, what he says to the sort of disgruntled middle class, I think is a lot more important. You're not going to get a whole lot of voters that vote for either side to read the agreement that comes out. They're just going to listen to the rhetoric. So I think we'll get some sort of agreement. It may be a little bit longer of a drawn-out process than Canadians would like to see. But I think this particular three-way trade relationship is the least at risk.
Okay, so we don't have to worry about NAFTA so much. Another thing we worry about here is the price of oil. WTI, around $65 a barrel, a lot better than it has been. You got any plays on the energy space or any belief that that sector could show us something this year?
I do. I think energy is going to stay strong for most of 2018. You know, I've probably mentioned this ad nauseum. You don't just turn spigots on in shale drilling. Now, we saw the biggest jump in rig counts on Friday that we've seen in a few weeks, but it isn't just rig counts now. They're extending the length of horizontal drilling on existing rigs, and yet still we've got a slow climb in production. I think the U.S. shale patch and by default the Canadian sands are suffering from a bit of fast growth hangover, and they don't want to do that again, and I don't blame them. We are seeing record levels of hedging further out the curve. So when you've got prices this high, it's a really good hedging environment because shale drillers, and again, by default sands, get to sell at a higher price and hedge out at prices that are high enough, right? So that's a good scenario for the longer term view of crude and those companies' profitability. So I think you have to start looking at the stocks and not so much the actual price of crude 6 months from now. But right now, the price of crude is supportive of drilling. It's supportive of CapEx. We're starting to see that creep up a little bit. So I'm very positive the energy space for the next 12 months.
All right, apart from obviously watching those very important earnings this week, in terms of that correction you're talking about coming perhaps in a matter of weeks, any big signposts for investors to say, whoa, what Bob's talking about is starting to happen?
Yeah, watch these 10-year yields. I mean, this is the first day that it's really been the #1 story as to where the yields have been going, but they've been moving. We went through the end of 2017 with talk of the flattening of the curve, and that had me concerned. And now what you've got is a little bit of steepening, but you've got a rather quick movement in the 10-year sector going all the way out to Germany, where you've got positive yields for the first time in about 3 years. So positive yields in the German bund, positive 10-year note, sort of the rise of the 10-year note yield up toward 275, 280. We get into that 280 handle. You start to worry a little bit that this is a sign of underlying inflation, and we've seen that in the PCE data and the GDP data, where you saw consumers a little bit more aggressive in the face of slightly lower growth. So that scares me a little bit. If we don't get higher GDP numbers that match the inflation, the Fed has to get involved. They have to get involved a little bit more aggressively to curb the inflation, and then that's where you see it, I think, hit the equities.
All right, Bob, as always, thanks for your time and for your insight.
Good to be here, Greg. Thank you.
That was Bob Iaccino, co-founder and chief market strategist at Path Trading Partners.